Welcome everyone to our discussion of stockholders' equities. Chapter 6, our last chapter in the textbook this semester. So we're going to wrap up. We've done assets, we've done liabilities. Now we're going to wrap up with stockholders' equity and the things that are going to, you'll see how it changes and what belongs there. So first of all, the term we've used since you started accounting is capital stock, but much more common is the idea of common stock, or it's typically referred to as either common or preferred. We'll get to preferred in a minute. So ownership, as we've discussed right from the get-go, is divided up into shares. Each share can then be sold to the investors. So it's rather than selling the whole business as a one lump, you can sell pieces to various investors, various stockholders, who would then own a share based on how many of those, in the old days, pieces of paper. Now nobody does it with pieces of paper very often. So if you have that, if you own stock or a share of stock in the corporation, you can vote to elect the board of directors. That's one of your rights that comes along with ownership. And sometimes there will be other major decisions by the corporation that will need to be approved by the stockholders. It certainly won't be everyday type of decisions. Instead, we elect the board of directors, who then chooses management who makes the day-to-day decisions. Board of directors handles the very big decisions, and then there are certain things that have to go back to the stockholders. Besides being able to vote on these important issues, you get a share of the income, or retained earnings, if you will, of the corporation. If the corporation goes out of business and there is retained earnings, you're entitled to that, divided up according to the shares of stock that are owned. The amount of your earnings that you receive is referred to as dividend. That obviously reduces the amount of your earnings that are still in the business, right? So the business has a particular, that's why we call it retained earnings. It's the money that has been earned by the corporation that has been kept by the corporation as retained earnings. When it's paid out to the shareholders in the form of cash or some other asset, that is a dividend and reduces that retained earnings, because now it is no longer retained, it has now been shared. So how do you know how much of the corporation or how much of the business you own? Okay, it depends on how many shares you have compared to the total. So owning one share of stock doesn't sound very impressive unless there's only 5 shares that have been sold. That means you own 1/5. That's pretty significant. If you own 1,000 shares, may be significant unless there are 1 billion shares that are owned by everybody. So that sounds a lot less of a percentage. But 1,000 out of 2,000 is a significant. So we have to know what it's based on when you understand how much you own or how many shares you own. So some terminology to help us decipher the total ownership and how much a particular shareholder may have of the corporation or be entitled to. Okay? And we're only talking about shares, even though these are also recorded as dollars in journal entries, and we'll get to that in a little bit. Right now we're talking about shares. So the first terminology is authorized shares. That's what is set when the corporation is formed. Their documents are filed with the state that say this is how many, the maximum shares that we can issue. That really, other than that, setting that maximum, it has no bearing on how much you own. So if you own 1/5 of the authorized shares, that doesn't matter. What matters is 1/5 of shares that have been sold, not authorized. So it's important only for that piece of information that we can't go over that amount when we sell shares. Issued, sold, same thing. Issued shares are sold to investors. This may be the total ownership. This may represent all the shares that are owned, unless there are treasury shares. And that is stock that was sold or issued to investors, but then at some point purchased back by the corporation. So when the corporation buys its own stock, that's called treasury stock. And that doesn't count towards ownership. So if a company has no treasury stock, has bought no treasury stock, then issued shares and outstanding shares would be the same and would represent the total ownership. So you would look how many shares you own compared to that issued and outstanding shares. If there are treasury stock, then outstanding shares, which represent total ownership, are the number of shares issued minus the treasury shares. So if we initially sold 1,000 shares and bought back 100, then 900 is really what counts, the outstanding shares. So I would look at my number of shares compared to 900 as total ownership. So if we own 200 shares and there are 2,000 shares issued and outstanding, so no treasury stock, then we own 5%, 100 divided by 2,000, right? And are entitled to exactly 5% of the income and 5% of the votes, unless there is a special provision in our bylaws that changes the voting percentages or something like that. Only outstanding shares get dividends. So when you pay dividends, you don't pay them to anybody other than the outstanding shareholders, and they're the only ones that vote. So when a company buys back its shares, it does not receive dividends from itself, right? And it doesn't vote on its board of directors on itself. So how would we record the selling of shares? This is selling new shares that have not been previously sold. Typically, we're going to exchange those shares for cash. We're going to debit cash for the amount of receipt. Okay? Received. We're going to credit common stock by the number of shares times the par value. This is an imaginary minimum value that's established when we start the corporation. When we file that initial paperwork, we're going to establish a par value, and we can never sell stock for less than that. It used to be a very much more important issue. It is no longer in today's world, but we still have that concept of par value, even though it's not as important as it used to be. We credit additional paid-in capital or paid-in capital in excess of par. There are a couple of different terms for the rest. So remember, your debits have to equal your credits. So the cash has to equal the amount of common stock and the additional paid-in capital, okay, to the credit. Sometimes you may exchange shares for other assets other than cash. It's pretty rare, but once in a while that will happen. A company will issue shares in exchange for a building or some other thing. That building is recorded at its fair value. So instead of debiting cash for the amount of cash received, we debit building at its fair value, and our credit would be the same as if we had sold it for cash. So at any given time, the amount in the common stock or additional paid-in capital T account. So if you're imagining the T accounts, as you sell shares, you're crediting that T account. You're putting things on the right side, right? And it's going to accumulate, carry over to the next year. So at any given time, you would be able to see in that T account the total amount that has been contributed by shareholders to the corporation for their shares. It would be what they paid in. It is not a measure of the value of those shares in a marketplace for like a publicly traded company like an Apple or an IBM. So on the common stock, on the balance sheet, the common stock account, what is going to be listed as common stock, the dollar amount should always be the number of shares issued not outstanding, but issued times the par value. So if they issued 8,000 shares and the par value is $1, then the dollar amount we would expect on the balance sheet as common stock would be 8,000. Now, what about preferred stock? It is not very common anymore. Very few companies have preferred stock today, but it was more popular in the past. The sale of preferred stock is really the same as selling common stock. You're still going to debit cash. You're still going to credit. Preferred stock is a common stock. Usually there will be little or no additional paid-in capital because par value for preferred stock is set much higher than par value for common stock. It's usually set at $100 per share, and that's usually what it's sold for. So it's usually sold a lot closer. The par value for common stock is usually very low, and so you sell it for more than the par value. But that's not usually the case with preferred stock. Why would someone want preferred stock versus common stock? They receive dividends before they are paid to common stockholders. That's where their preference comes in. They're not guaranteed. Nobody has to pay dividends. The dividends are determined by the board of directors. But you can't give any money to the common stockholders until you have given all the preferred stockholders what they have been promised. Okay? And there's usually a percentage of the par value or a set dollar amount that has been promised. Not guaranteed, but promised. And therefore, that has to be satisfied before you can give any money to the common stockholders. That's their preference. Sometimes they get voting rights, but usually not. And in bankruptcy, the company falls apart, preferred stockholders get their money back before common stock. They have to get all their money back before the common stockholders get any money back. All right, that brings us to the concept of treasury stock. We introduced that earlier. It's the idea that a company buy back its own stock. Maybe to prop up the price by creating more demand, prevent takeover because company outside of the company is trying to buy up the shares and therefore we buy them and so that they can't. Or we may use those shares to turn around and give to employees in one form or another to compensate them instead of cash. So how do we record or account for this treasury stock, this purchase of our own stock? Well, we're going to use the cost method. We're going to debit treasury stock for exactly the cost. We're going to have a new account called treasury stock. It is a contra equity account. It's going to be the last account on our balance sheet. It's going to be subtracted from the other equity accounts. That's why it's called contra equity. So it's always going to be, you might say, in parentheses or a negative or subtracted. And then we're going to credit cash for the amount paid. Don't get too fancy on me. Just debit for the cost and credit cash for the amount paid. So the number of shares issued, when I buy back treasury stock, the number of shares issued does not change. And common stock does not change. Additional paid-in capital does not change. But the number of shares outstanding does, because remember, the number of shares outstanding is the number of shares issued minus the treasury stock. More treasury stock means less shares outstanding. And again, a reminder, we talked about this earlier, treasury shares do not receive dividends and do not vote. So they really don't count as owners at the current time, but we have to still need to account for them. So sometimes a company takes the stock they rebought by the company and sells it to someone else, maybe an employees or others, but they resell it. So this is not selling stock, new stock. This is reselling treasury stock that was purchased and now we're going to resell it. When we do that, we debit cash for the amount received. That's the easy part. We credit treasury stock for the number of shares sold times the original cost. So when we have to look back in our records, see when we bought that treasury stock and what we paid for it, and then we need to credit treasury stock for the number of shares we sold times that cost. That's going to make our T account go down, right? Because treasury stock, when we buy it, is a debit to treasury stock. When we sell it, it's a credit to treasury stock. Treasury stock is a contra equity, so even though it is in the equity section, it goes up with the debit and down with the credit. Okay, so it's going to go down when we sell it. The difference between what we sell it for, the cash, and what we bought it for, the credit to treasury stock, goes in additional paid-in capital. Typically, it's going to be a credit to additional paid-in capital, but it could be a debit to additional paid-in capital. It is not a gain or loss. It does not go on the income statement. FASB is very specific about that. You cannot have that gain or loss on the income statement. So, the number of shares in the treasury stock goes down when they sell it, and the number of shares outstanding goes up, right? Because the issued share didn't change, but the number of treasury shares goes down. And remember, the shares outstanding is issued minus treasury. All right, some things about cash dividends. The amount and timing are determined, as we said earlier, by the board of directors. When they vote and decide that they're going to give a dividend, that's called the declaration date or the dividend being declared. We debit retained earnings and we credit a liability, because at that point we actually owe, it is a legal obligation to pay the shareholders that money. That's when it is announced, that sort of thing. The date of record is the date when the list of shareholders is made. No journal entry is made. We simply count up who it is that gets the dividend, because in a publicly traded company like Apple, the shareholders are changing every day. So there has to be a day at which we say, okay, this is the day we determine who gets the dividend, and anybody who owns stock on that day gets the dividend. Anybody who buys it the next day doesn't. Date of payment is when we actually pay out the money to those determined shareholders. So we debit the dividend payable. Now it's zero, right? We've paid off the liability and we credit cash. So 2 journal entries: we debit retained earnings, credit dividend payable. Then we pay it, we debit the dividend payable and credit cash. So the end result is we've made retained earnings go down and we've made cash go down. Now, stock dividends, much rarer than cash dividends. Instead of cash, we're going to give you more stock. Usually we're going to state that as a percentage. So a 50% stock dividend is we're going to give you a 50% more, or 50 shares. If you own 100, we're going to give you 50 more. 80% stock dividend would be 80 more shares. 100% stock dividend, if you had 100, you'd get another 100, and you'd have 200 total. The more shares means there's a smaller piece of the company and the price drops. Each share is a smaller piece. So it really doesn't improve your situation as a shareholder. You own the same percentage of the total shares outstanding as you did before. We do make a journal entry with stock dividends. We debit retained earnings and we credit the same way as we did when we sold new stock. We credit additional paid-in capital and common stock. The amount of the journal entry is the number of shares times the market price for small dividends, whatever the price is out in the market, and we multiply by a par value for large dividends. Most of the time you're going to be a large dividend, so you're going to use par value. Remember, that's very low, so the amount is going to be low. Remember that total stockholders' equity does not change with a stock dividend. Even though you move it around, you increase stock, increase common stock, additional paid-in capital, and decrease retained earnings, the total stockholders' equity does not change, and therefore neither does total assets. Stock splits, I like to say, are much ado about nothing. Meaning I want you to imagine a stock split is if you had a share of stock, and if you think of it as a piece of paper evidencing your stock, someone takes your shares, cuts them in half, and gives them back to you and says, oh, you have twice as many shares. That's exactly what happens. Problem is, each of those shares is now worth half as much. So you're exactly the same. You have exactly the same amount of paper as you had before. Imagine if I take your piece of pizza, I cut it in half and give it back to you, the same piece, cut it in half. Okay, you have twice as many pieces, but you have the same amount of pizza. Gets a lot of press because it's a positive sign usually for a company. Okay, but no real change to any of the parts of the business. Same share of profits, same part of the equity, sort of thing. You're in no better situation after as you were before. They're going to cut, the price is going to cut in half, the dividend's going to cut in half, all that kind of thing is going to change to reflect that. So our last situation that we want to talk about is what's earnings per share. This is perhaps the most talked about number on the financial statements. It's at the bottom of the income statement. It needs to be there according to U.S. GAAP. Every income statement, publicly traded company must calculate this. We take the net income, we subtract preferred dividends. If you have no preferred stock and no preferred dividends, you can skip that step. And then divide by the shares outstanding. Okay, remember that we know what shares outstanding are, the shares issued minus the treasury stock. That number, the shares outstanding, is extra important because of this calculation, earnings per share. Basically, it's a measure of the dollar amount earned by the company for one share. So if the earnings per share is $3 and I own 100 shares, you could say the company earned $300 for me this year. So I have claim on $300 of retained earnings for this year, plus any retained earnings from previous years. Okay, so if my shares outstanding goes up or down, this calculation of earnings per share will go the opposite direction. The more shares outstanding, the low earnings per share goes bottom, because remember, it's on the bottom of our fraction or our ratio. We're dividing by the shares outstanding. And we do what's called a weighted average shares outstanding, which means that we mathematically average the number of shares that we have during the year to get this calculation. So that's our explanation of the material. Second podcast is going to show examples, including journal entries and calculations to show each of these concepts and how they would actually work out on financial statements.